What exactly is Jerome Powell going to do next? How is monetary policy going to affect not just the overall stock markets, but also commodities? And furthermore, how is the FTX fallout going to affect the rest of the crypto sector and specifically other exchanges like Coinbase? We'll be talking about all these things with our next guest, who is an expert on a lot of different sectors of the economy and asset classes. He is Will Rhind, CEO of GraniteShares. Welcome back to the show, Will.
Thanks, David. Good to see you.
Well, you and I have been working together for quite a number of years now, and we always usually focus on the commodities, and we still will today. I want to talk about the overall commodities complex and gold, but not many people might know this about GraniteShares. Not just do you have one of the lowest cost gold ETFs, BAR, B-A-R, but you also have a short Tesla ETF. You have a 1.75 times long Apple ETF. And you have a Coinbase ETF, CONL. So you are well positioned to talk about a lot of different things besides commodities. So I want to start with the broad equities markets first, before we drill down into specific stocks and asset classes. As you know, the S&P 500 has been in slight recovery mode, shall we say, over the last month, ever since it bottomed in mid-October. It's been making a new high, but it hasn't really broken its previous high from a few months ago. I think everyone's wondering whether or not it will make a new higher high, which may signal bullish momentum that can be sustained. What's your view?
I think that's right, David. I mean, I think that December, actually, funny enough, is one of those months of the year where it's one of the strongest months for stocks. And, looking back in history, I mean, think of what happened, obviously, last year, which was where we saw December being really that final flush of the year that led to the peak at the end of 2021. So I think at the moment, it seems like the rally can continue to the end of the year. And I think it will, because interest rates seem to be on their way down in terms of the 10-year. We obviously heard comments yesterday from Chair Powell about inflation and rate rise expectations seemingly coming off from the more hawkish tone we've heard before. And so I think that's really the key for markets, is about expectations of smaller interest rate rises going forward, on the back of inflation moderating here.
Okay. Interest rate rises are going to continue. Jerome Powell did say very clearly that he's going to keep at it until the job is done. But you're right, he is signaling a slower pace of rate hikes. How is this going to affect equity valuations?
I think that, clearly that's good for valuations because one of the things that, if not the thing that's really held the market back and really contributed to the majority of the losses has obviously been the rapid rise in interest rates and the impact that interest rates have, particularly on the forward cash flows of companies, but particularly those companies that were much more exposed, long dated cash flows that you find particularly on the technology companies. Mm-hmm. So I think rising interest rates, we're still gonna have rising interest rates. I think it's more just the pace and the size of those rises are going to moderate. Yeah. As alongside inflation expectations coming down.
You have two tech stock ETFs, Apple and Tesla. So just talking about the tech sector overall, because tech stocks are a big component of even the S&P 500. Suppose Jerome Powell keeps rates elevated. Let's suppose he doesn't pivot and reduce rates anytime soon. He just raises them and then just keeps them elevated for some sustained period of time without raising them further. Do you think tech stocks are well positioned, or tech companies are well positioned to adjust for a sustained period of a higher cost of capital?
I think that's a very, very difficult question to answer, David, and I'll try and answer it by saying I think it's going to be split into two camps. You got to remember that there are technology companies out there that are some of the most profitable companies in the world. We're talking about the mega tech, yes. The mega cap tech stocks, the Apples, the Googles, et cetera, of the world. Then there's another camp that are among the least profitable companies in the world. And those are the much more speculative stocks that clearly have been hurt, much more this year. So if you think about, some interesting data points is if you go back to 2000, when you had the huge dot-com collapse, so stocks like Amazon declined 45%, in 2000. Actually, interestingly enough, that's almost around where Amazon is today. In other words, 45% decline from the peak this year. Companies like Apple have been more resilient. losing about 20%, versus before. But I think it gives you an idea that some of these megatech companies, they have come down significantly in terms of valuation. But then look at some of the less profitable or not profitable companies, and you're talking about losses of 80% plus in some of those names.
Okay, so definitely we could say a K-shaped kind of investment philosophy there in that overall sector.
Yeah.
Well, okay. I do want to touch on the holdings that you have and the ETFs that you have, but going back to the Federal Reserve, their mandate is to fight inflation and maximize employment. Let's talk about the inflation side first. Now, you were actually correct in calling for higher inflation, even before a lot of people were saying at the time. I remember back in May 2021, so last year, you said that shrinkflation would happen first, and actually a lot of people were tweeting about that. They were tweeting their grocery store items getting smaller for the same price. So first, you said first there would be shrinkflation, then prices would actually rise in nominal terms.
It's a phenomenon that typically is the first step or the first wave before outright, higher prices. So what I'm talking about here is this concept called shrinkflation. And shrinkflation is, if you think about a consumer product that you buy maybe on a regular basis, that might be a box of toilet rolls, it might be a thing of tomato ketchup, whatever it may be. The point is that the price of that particular product is still the same. But if you look very closely, you're actually getting a smaller amount than you were, say, 6 months ago or 12 months ago for the same price. And this is a way that manufacturers kind of use sleight of hand to disguise the inflationary pressures that they are feeling.
We've seen both of those things. Will, what's next?
Well, next we're going to see prices come down, and
okay,
that's already happening. That's already happening in some sectors.
Chicken's
as you
coming
saw
down.
with the as you saw with the PCE number, that it moderated less than market expectations, which is, as some people say, the Fed's preferred measure of inflation, because it excludes the more volatile items such as food and energy, particularly. So core inflation seems like it's moderating. And the big sort of elephant in the room, which is really the labor market, which has been so strong for so long, really, I think that once those unemployment numbers, once those layoffs really start to hit, then we start to get into the real recession, which is going to come most likely sometime next year. But I think that's all coming end of year. We've seen obviously with a lot of companies making announcements, and indeed some companies that are in worse situations clearly making more immediate fires or more immediate eliminations. But the broader market and the broader contraction, I think, will start around year end, and that will be a big theme for next year.
All right, so you're saying a real recession is going to come by next year. You're not alone in that call, but I'd just like to point to some indicators that may be a little bit confusing for some people who think a recession is coming. If you just take a look at unemployment, for example, it's still relatively low. The labor market is tightening. The JOLTS numbers came in yesterday. However, if you take a look at retail sales, for example, it continues to make new all-time highs in nominal terms, not inflation-adjusted terms. So people are spending. Shopify recorded a 17% increase in their consumers, the number of consumers on their platform on Black Friday. So people are still spending money. Well, I don't know where this strong consumer sentiment is necessarily coming from, if everyone agrees with you.
Yeah, I mean, look, prices are going up, David. I mean, that's inflation. So, from a retail sales perspective, really the question is, are people buying more stuff, or are they just buying the same or similar quantity of stuff, but paying higher prices? And that's really the key thing. But I still think the consumer is more or less in good shape right now, because providing that you've got a job, providing you're in employment, the effects of the last couple of years mean that savings, et cetera, is still relatively healthy. I think that all changes clearly when we start to get these layoffs filtering through the economy, and indeed the labor market goes into reverse. And right now, the gains that we're seeing, the gains are mainly still coming from, let's call it the lower part of the employment market. There's a more, the hospitality type roles, which were so decimated through COVID. These are less about the quote unquote white collar jobs at the higher end of the market. And clearly, given that 70% of US GDP is the consumer, once you see that impacting the higher earning part of the economy, I think that's when you start to see these things go into reverse.
Mm-hmm. All right. Let's talk about the labor side then, and because that affects what the Fed's going to do. I wonder whether or not the labor market will deteriorate significantly such that the Fed will have to pivot before inflation comes down anywhere near 2%. Is that possible in the recession that's to come?
It's absolutely possible, and I don't think that you could say that it's a pivot already. I mean, clearly, it's some softer language, and really that's about it at this stage. But I think they have to moderate. I think the pace of rate hikes already has been arguably too much, i.e. too high and too quick. And you can see that in terms of the US housing market, that's really contracting and contracting quickly as financial conditions have tightened. So I think we're already at a point where these incremental rate hikes from here are really just exacerbating the situation and maybe amplifying whatever recession is going to come down next year.
Okay, so let's talk about the commodities then. Given that you predict a recession, that obviously affects commodities in different ways. One can take a look at a hard asset like gold and say that maybe perhaps a recession might be beneficial to gold. Another viewpoint may be that the Federal Reserve is going to continue raising into the recession, which is something they haven't done before, which would dampen gold's price. What do you think is going to happen? What's more likely to happen in terms of gold headwinds or tailwinds?
Well, I think gold is a good example, and maybe to take your first point that part of the reason why gold prices have rallied is this idea that interest rates are going to moderate, or the path at least of interest rate hikes now are going to moderate because inflation is on the way down. So gold, has lost value on the back of it being a non-interest bearing asset class. But I think it's the key here that gold can continue to go high, even though we know there are going to be more interest rate hikes coming down. But really the key thing that's impacting gold at the moment is the dollar declining. And it seems like the dollar peak, whether it's the absolute peak or not, we don't know, but the dollar's certainly moderated from the absolute high that we saw a couple of months ago. So dollar going down, I think it's good for gold at the moment, and gold can continue from here. As regards to recession, you're absolutely right. I think in a recessionary environment, gold can perform well, particularly when people have a fear of either credit or counterparty risk, like we saw in 2008. We're not there yet, but what we haven't really seen is those defaults come through. We've seen the tightening of financial conditions. We're starting to see that strain happening in the housing market, but clearly the higher those rates go, the higher those financing costs get. That's going to impact not just the housing market, it's going to impact markets like the autos and other things where finance, credit cards, where financing is really ubiquitous. So I think from that perspective, gold could do well in that environment similar to 2008, where now people have concerns over defaults in the market and concerns re-emerge about counterparty and credit risk.
Okay, now gold has been relatively strong compared to other assets like stocks and cryptocurrencies. It's been flat, slightly down on the year, but still relatively strong. A lot of this performance that gold has seen this year was due to a strong dollar. In other words, people have expected gold to go up in light of high inflationary pressures and an unwinding economy, but the strong dollar has held gold back from appreciating even more. So the question is obviously how much longer the dollar can remain strong, and when we'll see a peak in the dollar.
Yeah, I think that's arguably already happened.
Okay.
Like I said, whether it's the absolute peak or not, time will tell. But certainly part of the resurgence in the gold price over the last few weeks has been on the back of the dollar declining from that high we saw in the last couple of months. So I think, as you rightly said, it has been a case of rate hikes have been very quick, very fast, and clearly that has powered the dollar and impacted gold negatively. But if we're now in an environment where the dollar is easing, it doesn't necessarily, even have to be falling. It's just that the expectations are that the dollar will moderate, stabilize. That, all things being equal, is good for gold and can provide a platform for gold to increase from here.
But if the Fed will continue to raise rates, would that not put further pressure upwards for the dollar?
It might do, David, but what we've seen so far is actually, those expectations come down, and therefore the dollar falling on the back of it. So in other words, the market was expecting perhaps higher interest rates and maybe a higher terminal rate. But if those expectations get adjusted or start to get adjusted down, that will most likely mean that the dollar falls as a result, because that peak or that high dollar expectation was based around a higher interest rate and ultimately a higher terminal rate.
Okay. But overall, then, do you think that the dollar will continue to be a strong leading indicator or coincident indicator for gold like it has been this year? Or do you think that inflationary expectations and perhaps other factors will take over as a more dominant driver for gold in 2023?
I think the dollar will still be really important because, again, if we take a step back, what has been happening is the United States really has been leading the world in terms of interest rate rises, and hiking rates, particularly hiking rates very quickly, and a lot of the other parts of the world really are nowhere near in terms of interest rate rises or levels same as the U.S. And clearly that was one of the reasons why the dollar got so strong and contributed to problems against the British pound in Europe and other emerging market currencies as well. But I think, going into next year, the dollar will still be important because I would expect the United States to still have interest rates that are higher than the majority of the developed world. But it's really just about the pace and ultimately the terminal rate that will really define the dollar's trajectory for next year.
Okay. So finally give us your gold price outlook, and we'll move on to other commodities.
Well, I think for gold to be where it is this year, gold has done incredibly well. So yes, gold is slightly down on the year, but as you rightly pointed out, it's outperformed other major asset classes like stocks. And so I think despite the massive headwinds that we've had for gold, we're going into a situation next year. Well, yes, we expect more interest rate rises. Yes, we expect inflation to moderate. And yes, we expect there to be a recession. But I think this is the kind of environment where people are prioritizing a more cautious or a more defensive approach. Clearly we've seen growth kind of go out the window and people moving much more into defensive or more conservative type names. And so I think that benefits gold. Clearly we haven't even touched on yet, but I know you want to talk about it, the debacle in cryptocurrencies. And so I think some of those assets that went into cryptocurrencies, back in the height of the bubble, some of those assets will go into something like gold. I think gold will be a beneficiary of the debacle in crypto, as again, people start to realize that, counterparty risk and credit risks are real things. And, with gold, it's the highest quality asset in the world that does not have any counterparty or credit risk.
Okay. I am going to get to the debacle in the second part of our interview, but just finishing up on the first part here, I want to finish up with oil. Oil is another asset that you follow. Oil has had a rough second half of the year. Give us a summary of what exactly happened ever since it peaked in the summer. It's been coming down, and extend that outlook into the following year, given your recessionary outlook as well.
Yeah, I think that's it, David. I mean, what oil has really struggled with is the Chinese situation, I think, more than anything else. I mean, clearly we know that your supply is severely restrained, and that's not going to go away, and it's not going to be fixed anytime soon. We've seen countries try and do their best, the US probably best example, to try and get oil prices lower by releasing strategic petroleum reserves onto the market. And trying to increase the supply to lower the price. But at the same time, we see OPEC Plus, making noises around trying to defend, higher prices and making it, I think, well known that if prices fall or continue to fall, they'll step in and curtail supply even more. But like I said, I think that's really all about the Chinese situation. This is about demand. We've seen big demand destruction from China with all the lockdowns. And so the oil price, at least for the short term, is largely dependent on that factor more than anything else. An X factor coming into the market is the price caps, which are soon to be agreed by the major currencies, and talking about Russian oil price caps. So that will be an X factor for the market. We just don't know at this stage exactly what will happen there and how markets will react to that. But that's something to keep an eye on.
A story from Reuters came in yesterday. I'll just read the first couple paragraphs here. Oil prices settled up by over $2 per barrel on yesterday, on signs of tighter supply, a weaker dollar, and optimism over Chinese demand recovery. Capping gains, the OPEC Plus decision to hold its December 4th meeting virtually signals little likelihood of a policy change, a source with direct knowledge of the matter told Reuters. So people are projecting tighter supply from OPEC. You talked about demand. Is this something that you agree with?
Yeah, no, absolutely. And that's really been the pattern that we've seen. We saw sort of a moderate price cut from them earlier on, but clearly haven't shown that appetite to increase supply, which is what the United States and other major developed economies have been looking to them to do. And hence why we've seen the United States in particular, go to other countries like Venezuela, et cetera, to try and get more barrels onto the market. But certainly from OPEC Plus, I wouldn't expect any major changes certainly coming into the end of the year. But I think supply will remain tight for the foreseeable future.
Yeah, I do want to bring up this story with you because you cover both gold and oil. This came in last week. Ghana plans to buy oil with gold instead of U.S. dollars. Now, Ghana is not representative of everybody else, but it's interesting. I'll just read the first paragraph of this Reuters story. Ghana's government is working on a new policy to buy oil products with gold rather than U.S. dollar reserves, says the vice president. That's interesting. What's going on? Why would someone do this?
Right. I don't know, but or I don't know how much gold they've got, but I think if you're in that situation, I would at least speculate that things are perhaps not all that good in the economy where you have to use your reserves, to buy assets, particularly such as oil.
Before we move on to the second part, well, let's get your outlook on the broad commodities complex. You do have a commodities fund, COMB, I believe is the ticker. So tell us what's going to happen to to ags, softs, hard assets we've talked about, the broader commodities complex.
Yeah, I think, similar to what we were discussing with gold, David, I think we're set up quite well. I mean, commodities have performed really well this year. And, relative to other asset classes, has really been the trade to be in this year. And I don't really see any signs of that changing, bar any sort of massive demand destruction that comes next year. But even despite the Chinese lockdowns, commodity demand has still been resilient. We've seen obviously European countries scramble to try and get particularly energy resources in place to cover them for the winter months. But I think that all of this leads to the same situation we've been talking about for a long time, which is the supply is really, really constrained in the majority of these key commodity markets. And that goes back, it's nothing to do with COVID, et cetera. It goes back for multiple years, last decade, at least, in terms of underinvestment in supply. And so that's now, coming home to roost. That will take a long time to change. And I think with the policies, the green policies that have been enacted by, most major governments around the world now, trying to enact a transition away from, hydrocarbons and fossil fuels to a more sustainable energy environment. That's going to require masses of certain commodities, such as copper, such as lithium, et cetera. And we just don't have the supply of those commodities right now. So there's going to be massive investment in some of those commodities in order to meet that energy transition. So I still think commodities are well placed here in this particular environment.